This has to be one of the most hated market rallies I've seen in quite some time, and don't get me wrong, I hate it too, but for far different reasons than most folks. I do believe that prices belong up here at elevated levels. After all, we are in a daily uptrend, and the divergences are resolving in a positive manner. And I don't believe that we belong down here based on some, quote, recession narrative that people continue to talk about. So why do I hate this rally? Well, it's been surrounded by economic data uncertainty causing heightened volatility, and as a responsible long-sided trader, we're looking for higher low pullbacks to get involved in. There haven't really been many of those up here at these higher highs as this trend has progressed. So although it does strike me as reasonable that markets are higher, it's been very difficult to be a new money long. Let me know in the comments section if you kind of agree with that assessment of markets here. However, let's keep it objective. Let's build a game plan into the remaining day of this trading week. I know I'm coming to you delayed on a Thursday, but let's kick things off by daily time frame chart. What's going on from a trend perspective? We've got lows, we've got higher lows, higher lows, higher lows along the way, and we've got highs, higher highs, higher highs. Beautiful higher highs producing a brand new higher high as of today's close. So two assumptions can be made based on what we've just drawn in. Number one is that we're clearly in a daily uptrend, and thus number two, because we're sitting on a higher high, we can pull back and afford to find a higher low. Where's the line in the sand on the daily time frame chart, you might ask? Well, it's technically way down below us at 429.25, the breakout level from the daily bull flag. I'm not advocating for this into the end of this week, but you can reason how this would possibly produce a higher low above that structure at 429.25. Again, not calling for it on tomorrow's session, just pointing out as long as we're above it, we're looking for a higher low. Into the future, we'll become concerned on a lower high, but again, with only one trading day left in the week, that would be a multiple bar setup. Let's not even bother with it right now. Now, does this mean that I'm just an advocate for, hey, let's jump in long and look for this thing to continue to the moon? Absolutely not. We do have a solid-bodied green bar here, and we are looking at a strong close at the highs of the trading range, but we're well extended through the upper edge of the expected move, and we are sitting at previous resistance coming from structure off to our left. It would be irresponsible almost to be searching for new money longs here as day trade scalps without some intraday structure that provides a higher low over 444. To talk with some more nuance, let's move on down to the hourly time frame chart and just understand what's at play here. So first and foremost, I want to talk about the FOMC pullback, right? This is that daily bull flag consolidation. There's your break. This is the FOMC pullback, right? We know that Tuesday morning, we gap up on the CPI print. Where does the FOMC initial breakdown go to and reverse out of? Right? Perfectly off of the gap fill reversal from the Tuesday morning session. So you have to think to yourself, if you're a stronger seller, a core positional type trader with a 3 to 9 month time horizon, and you start hearing Jerome Powell talk about a terminal rate that needs to go upwards towards 5.6%, if you're a stronger seller, you hear this and you don't like it, you're not stopping at a gap fill reversal level. So what this indicates to me is that this is momentum shorts in the downward direction or liquidation break from poorly positioned longs at the highs of Wednesday's session. It's not true selling strength in the downward direction. So of course, on today's session, we get confirmation with an intraday higher low above the Wednesday high. And I think that's the first pullback level that we want to be looking for. So we've built the case already that buyers remain in control. That goes without saying at this point in time. But if we do start to see a pullback tomorrow morning, 438.75 is the first key level to really be evaluating. And there's two ways that I think that this may unfold. Number one, because we're in such a strong daily uptrend that formed on today's session, strong daily bar, if we see continuation that pops over 444 and then comes back down underneath, you're looking for a lower high underneath and then a flush through the opening print if it remains elevated in the first place for that pullback to start to unfold. And if you want to participate in that, as long as you have good risk reward in the downward direction, so be it, right? But at the end of the day, the more responsible trade in the direction of the overall trend would be to flip to a bull down here, looking for a reversal on the retest of Wednesday's high. You want to look for hammer candles, double bottoms, inverted head and shoulders. Any reversal pattern kind of goes at 438.75. So that's the main level I'll be watching into the Friday session if we see a pullback. Certainly willing to take a stab at this type of trade as long as we have a reasonable stop loss on the pullback short in the first place. And the only long, I don't even know if I would want to participate this on a Friday session, but if we get a break and then higher low over 444. If there's good risk reward, I mean, maybe it's worth taking a stab there. The daily trend is so strong. We know that this is a runaway train. Maybe if you've got tight risk there, I would not recommend trying to swing that over the weekend. Remember that Monday the market is closed as well. You certainly have a lot of headline risk out there Saturday, Sunday, Monday. So that's really the game plan, right? Looking for a fake break, lower high back down underneath, flush the opening print. You can trade for this pullback when and if we get here, looking for reversals back in the upward direction to stay in alignment with our daily trend. Why else do we want to respect 438.75? If we take out the Fibonacci's from the breakout, remember that this is the daily bull flag consolidation. This is the Friday gap up from last week. If we come in with the fibs from the low there, to the top of this move, if this truly is going to mark the high, your 38.2 Fibonacci retracement is sitting right at that level. And keep in mind, if we're expecting the fake break first and then a move back into range, that would drag this up a little bit, dragging this up a little bit, providing better confluence of support around 438.75. So that's building the case for that. What else is going on here? If we take out our anchored VWAP, and anchor it to that same Friday session of last week, notice that it's probably not going to be there on Friday, but it's slowly creeping in the upward direction over time, perhaps maybe early next week. It will meet us there for confluence of support, so I would be looking out for that. If there is a more aggressive pullback in the downward direction, I would keep an eye on this. Like if the morning is just an outright flush, keep an eye on that anchored VWAP, right? It's clearly acting as support from the Wednesday FOMC pullback as well, something to have in mind. Let's take a look at some supporting evidence now. Market internals are always Exhibit A. If you're not familiar with this screen, check out the tutorial in the top right-hand corner. For the most part, let's compare today's activity on the rally versus the FOMC drawdown. In terms of volume flows, never got significant outflows on Wednesday, certainly did get significant inflows on today's session. The net cumulative effect of volume flows this week is positive 650 million, well above our substantial read, which we classify as 500 million. In terms of the advanced decline line, notice that we do make a strong move to and through the zero line on the FOMC volatility, but we never get down below into trend zone. And on today's rally, instead of things weakening into the close, like what we kind of saw on the Tuesday gap and go day, we actually got stronger into the close where the advanced decline line continued to climb up towards that 1500 mark, close to trend zone higher. So I would say that's definitely a reason to be a believer thus far in this rally. If we look at the cumulative tick, certainly did get negative on the FOMC volatility coming from a flat morning read, but look at today's cumulative build, right? It builds into the close, telling us that this is not just short covering, it is sustained buying across the exchange, which is worth respecting. Now, I also have to bring up that Tuesday, on this gap and go type day, the cumulative tick was not supportive of that rally. So that was a little bit of a red flag, but post FOMC, when all the cards are on the table, I would certainly look at today's session and say, yes, the inflows, the advanced decliner, and the cumulative tick do support the rally that we saw in the upward direction. Exhibit B is market profile. If you're not familiar with this screen, check out the tutorial in the top right-hand corner. Let's keep it very simple. Where is value and where is the point of control? Well, on today's session, value does migrate higher with price, as does the point of control, and they are completely break away from the Wednesday value and point of control. But even if we look at Wednesday in isolation, when we saw the FOMC breakdown, where did value close? Certainly higher in the profile as opposed to at the lows, and so did the point of control. So folks were willing to commit volume at these higher prices, and on the breakdown of the Tuesday low, not only was it a gap close, but we were technically threatening a rotation through thin structure back here. It just didn't unfold. So you could say it speaks to the bullish nature of the market, and that's fine, or you could say it speaks to the lack of serious sellers in the market, which I believe is the more appropriate way of phrasing it, with the inability to rotate through the thin structure and be drawn towards the lower point of control. So everything that we're seeing in front of us is more supportive of the upside narrative, but again, it probably doesn't make sense to chase the higher highs unless we have reasonable intraday risk-reward ratio. We do have a poor high that could use some repair on today's session, so carry that forward. If tested, it could lead to that fake break, but watch for price acceptance back down in today's range for that situation we talked about earlier. Value area low does strike me as a reasonable target. Notice that its confluence with your Wednesday high, 4440 is the number. Jumping back on over to the platform to evaluate the daily performance of our sectors first reveals that as this big breakout is taking place in the market, it's being led by communications, the tech sector, financial sector, and even consumer discretionary. Now, I don't know about you, but that is an all-star lineup in terms of risk on, and that's exactly the posture that I would want to see as the market is breaking out and making a substantial move in the upward direction. At the bottom of the barrel is consumer staples, utilities, real estate, and energy, all risk-off D for defensive sectors, and again, although they are green, they are lagging, proving that posture is favorable for an upside move here. If we sort by percent change on the week, we are still seeing that the tech sector is leading the pack here, up a whopping 4.48%, but it's followed by materials, industrials, communications are a little bit lower, as are discretionaries here, and financials really want to be higher on this list for a more optimistic look. Let's take a look at the structural charts, though, and evaluate if there are any larger red flags we need to be concerned with. The XLK breaking out of its daily bull flag, coming into the measured move and prior structural resistance at 175.85. It does support more of the bullish look for our market right now, but it's totally reasonable that we do see this Friday pullback off of a known area of resistance. If we take a look at the XLB materials, equal high here, even if it does start to break out, it's a lightweight sector, won't be all that influential for the S&P. XLI industrials breaking this multi-month balance range in the upward direction. The measured move based on a range double brings you closer to 109 on the upside. That is bullish pressure for the markets. XLC communications resolving this higher low pullback in the upward direction. We have a first break after 2 days of consolidation. If this is day one, we can see day two follow through, and looking for 66.25 on the upside would obviously support the bullish narrative for markets. If it wants to consolidate and go sideways, it's not in jeopardy of changing trend, just like the XLK. So not the end of the world. This one can, though, see a little bit more continuation, unlike the XLK. XLY, what's going on with discretionary? This too is sitting at a known area of resistance from back here. It did produce a bullish sort of close over the hammer high on today's session after testing some of these lows. So I would have more of a bullish edge looking at this chart. We've got a multi-day balance really in play here. If we can breach 166.75, it would be helpful to continue this rally. But if it does just remain sideways in range here, it's not the end of the world. Not going to change trend anytime soon out of the XLY. If we start to flush the lows of this area at 164, definitely intraday bearish pressure. If you pair that with an XLK pullback, that of course brings in your deeper move in the S&P 500. Let's take a look at the XLP, finally starting to resolve this flag in the upward direction, but it's not outperforming on the week, and it's certainly not outperforming on the day. So this is helpful. We don't want things falling off of a cliff. We just don't want leadership in the D for defensive sectors, and we're not seeing that yet. The real estate sector mildly higher. XLV holding up beautifully inside of this range. It held this higher low. Remember that this is the second heaviest weighted sector by market cap. Can't have it falling off of a cliff, and this is exactly the opposite of that. It's holding up nicely. It's also not exhibiting leadership over these highs. XLF, this is where there's a little bit more work to be done. This double bottom, don't get me wrong, is playing out in the upward direction. We continue to see that hold over 32.85. We are sitting at the daily 200 SMA as well as structural resistance from back here at 33.65. In a picture perfect world, this starts to break into the end of this week, and it keeps the pullback very mild in the S&P 500, right? XLF picks up some of the slack. It breaks out as the XLK is pulling back, and the S&P itself gives us that mild pullback to Wednesday's high and not the deeper move further into the previous range. So watching this closely here, it would, based on the green bar on today's session engulfing the prior red bar, I would say it may have some legs into the end of the week. I wouldn't write this one off as being unable to break out on tomorrow's session. Energy, what's going on here? Any leadership? Absolutely not. It's just mildly sideways, not producing any downside pressure. And utilities, same idea. Inverted head and shoulders is on the table. A breach of 66.80 could get interesting for some follow through in the upward direction, but not exhibiting leadership, not an issue. 68 would be the target. Here's the sector ratio grid. If you're not familiar with this screen, check out the tutorial in the top right-hand corner on how to set it up. This chart really speaks for itself. XLK is indicating risk on, as is the XLY, and the closest tie, the XLC communications, flattening out but still well above an upward sloping 50 SMA. We know that the work needs to be done in the financial sector. We just covered that on the structural chart itself. The ratio wants to perk up. If we see a breakout tomorrow out of financials over 33.65 as the S&P gets a mild pullback based on the XLK pulling back, that would certainly perk this ratio up. That would be helpful from a risk posturing perspective. If we look at the risk off sector, this is deteriorating, 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 and deteriorating. Very difficult to say that we have a risk-off environment. Everything is pointing to risk on, and it will improve if financials can start to play catch-up. If we take a look at the XLY over the XLP, so growth versus value, of course, growth continues to dramatically outperform, producing a significant higher high and even an equal high back to this level here. Can very well reasonably afford a higher low pullback and remain in a risk-on posture. The dollar broke down significantly on on today's session well underneath 103.50. If I just drop it to a 15-minute intraday time frame chart, you can see a clear waterfall in the downward direction. The one reason to be slightly skeptical about continuation here is just that the equivalent of the dollar breaking 103 in the downward direction more firmly should have correlated with gold recapturing 2,000. It doesn't have to be one-to-one. We don't need to get over 2,000 for the relationship to remain bullish, but for the most part, just monitor the relationship into the end of this week. Maybe the dollar starts to slow down, at least in the downward direction, supporting the idea that maybe equities see a pullback or some slowdown themselves. If we take a look at interest rates, it's no surprise that the tech sector did so well this week. If we see what's going on here and the big breakdown on today's session, certainly coming back down towards the neckline of what could start to be construed as a double top. Now, don't get me wrong, we are still above that neckline at 36.40, and it will not be a double top until we break the neckline, but it of course does speak to bullish activity in the XLK, right, with lower rates. Now, the one concern is, why are rates moving lower aggressively if we know that there's perhaps one or two more rate hikes in the tank from the FOMC and Jerome Powell? Let's take a look at the tracker tool to dissect that. So here's the Fed tracker tool pricing in higher odds of a 25 basis point rate hike in the next FOMC meeting, which is going to be on July 26th. But if you recall, the SEP outlined that the potential terminal rate may want to be closer to 5.6, indicating 2 rate hikes into the end of this year. If we look at the probabilities tab, the market's not buying it. We're seeing one more rate hike and then holding high and steady into the remainder of this year, starting cuts from that more aggressive higher stance into the beginning of next year, 2024. And if you were watching the demeanor of Jerome Powell during the press conference, to me it seems as though he wanted to be a dove and the overall committee was forcing him to be more of a hawk. He said skip, oops, I meant decision early on in the meeting, and he kept talking about differentiating between the terminal rate being one issue and the pace at which we achieve the terminal rate as a completely separate issue. It seems as though he is more on board with a pause, and that's obviously dovish, more supportive of a more aggressive bullish tech sector, as opposed to hawkish, thinking about 2 rate hikes into the end of this year. If we take a look at the CPI data, we know that it actually came in quite favorable, hitting that forecast, even coming in slightly underneath forecast. So the trend is in the right direction. The core CPI is where we see issues, specifically in housing services, but Jerome Powell once again wants to be data dependent and wants to see what the next couple of readings look like. If we take a look at the outcome of that, here it is. Just want to show you services less energy. This is where the issue is, right? Here is the month over month, and the April read was 0.4, the May read was 0.4, unchanged. Shelter actually ticking higher. This is an issue, right? This is going to be the thing that forces Jerome Powell's hand to potentially give us 2 rate hikes if in the very next CPI, or better yet PCE read, we don't see shelter start to come down in terms of inflation. So if you are someone who follows the more fundamental narrative, keep an eye on shelter for our next PCE reading. That is going to be next up in the cycle of economic data. The TLT flight to safety trade is completely off the table, speaking to risk on conditions down below in equities. If we take a look at something like our HYG, it is actually playing nicely, finding higher highs along with the market, which is also finding higher highs. Are they that aggressive? Certainly not, and it is worth keeping an eye on, but it is playing more nicely than giving us a negative divergence. And I also want to bring up Bitcoin as a risk indication, simply noting what's going on with Coinbase, obviously, and the SEC investigations. It seems isolated specifically to Coinbase and the company itself. People still want to hold Bitcoin. If we were going to break down more substantially on this move from the SEC investigation, we had thin structure to retrace. It just simply isn't what's happening, right? We are actually producing a hammer candle here showing that sellers are reluctant to unload Bitcoin underneath the prior weekly low, and we're actually moving slightly further into the prior weekly range. It's not one-to-one with equities down below, but it certainly does support more of a risk-on environment in the overall financial markets. Market breadth is improving in new highs versus lows. If we take a look at the SPX A200R stocks over their 200 SMA in the S&P 500, improving instead of deteriorating. And perhaps the most important divergence that we've been keeping an eye on is the SPX A50R on a daily time frame chart. Remember that this represented the top of the range back here. We've finally broken it in the upward direction. Don't get me wrong, it's certainly not where it wants to be in terms of the nature of this move being reflected in it, but it steps in the right direction. The market breadth is broadening, not contracting. We could take a look at the RSP as well. This is the equal weight S&P 500 up at the top. Notice that it broke this resistance instead of rejecting there for an equal/lower high. Again, don't get me wrong, it's not where it needs to be. This equivalent back here has already broken in the weighted S&P, but it steps in the right direction, not the wrong direction. And if we take a look at the Dow Industrials versus transports, they're moving almost in lockstep. Here you can see that we've got an equal/higher high, and back here we are producing an equal/higher high. I would want to see if industrials can play catch up and actually break the top of the prior range from back here at 34,590. V is for volatility, and it remains floored underneath the 15 handle, but folks, just remember that the market does not need to crash just because VIX is starting to get low. If you know your market history, the VIX is actually quite comfortable underneath the 15 handle. Outside of the sickness experience for the past couple of years, VIX historically stays below 15, right? So not a big red flag here. Anybody telling you that the market must crash because the VIX is depressed simply doesn't understand market history or market conditions. If we look at the VVIX, take it one step further, looking behind the curtain, we've broken the support trend line. We're continuing to reject the backtest of that trend line. We're certainly not rolling over aggressively. We're not at complacency zone yet, but we're also not elevated up and over the 103 handle. Not really seeing any red flags out of volatility at this point in time. VIX futures clearly in contango, 9 versus 30-day VIX down here underneath the zero line. We'll give credit where credit is due. A little bit of uncertainty crept in around the sort of economic headlines that we were getting, CPI, PPI, FOMC, but still staying underneath the zero print does strike me as healthy for the current market environment, and this is rotating lower, right? Elevated for the economic data, and now we'll see if this wants to simmer off and give us some days down here in this controlled range. Now, if the market does pull back tomorrow, of course, this will be elevated, but the data set isn't really built out strong enough yet to make any determinations. Their overall volatility as a whole is not concerning right now. QQQ daily time frame chart does continuously produce higher lows here as well as higher highs along the way, just like the S&P producing a higher high into today's close, and thus we can afford a higher low pullback. The line in the sand on the daily time frame chart is here. That level is going to be at 357.25. It led to the breakout on the Monday session in your QQQ. A big difference here, though, is that we are not sitting at structural resistance from off to the left, and if we do see continuation, the next level to target is 375.65, once again being extended through the upper edge of this week's expected move. I do think that chasing new money longs up here is fairly risky. If we take a look at the hourly time frame chart to understand where the more picture perfect and reasonable pullback comes in, it's going to be closer to here. That's your Wednesday high, just like the S&P 500. That number is 365.75. If we look at the difference between the Qs and the S&P, we actually closed the gap on the Tuesday session there, and we go right to it on the FOMC drawdown. I would still say that this is a bullish indication, but it does weaken the level at this 360.75, right? There's definitely going to be some stops that are placed underneath there, and if we go on a stop run breaking that weak level, we should expect a thin structure breakdown, to retest that daily line in the sand. There's your 357.25 that we were just referring to. Just like in the S&P 500, we can take out our Fibonacci's. We want to come from the low of the breakout day. Remember that the Qs did not break out on Friday of last week. They broke out on Monday. If we come from that low up to today's high, your 38.2 Fibonacci is right at the Wednesday high pullback we were just talking about, 365.75. And if we throw on the anchored VWAP, and I've already adjusted it to go to Monday instead of Friday, you'll notice that it's going to slowly start to creep higher and provide confluence of support at that 365.75, perhaps sooner than what we saw in the S&P 500, right? It's a little bit further underneath in the S&Ps, so just continuing to build the case here. It won't be there instantly on the open, but maybe later on in the day's session, it could provide support confluence at 365.75. Let's take a look at the market internals for the NQ, Nasdaq, right? We certainly are seeing substantial inflows, well above positive 500 million. Even if you wanted to use a higher watermark level, something like 600, we are still above that as well. 891 million inflows. Not significant on today's session, so a little bit of weakness as compared to the S&P 500. Same thing with the advanced decline line, don't get me wrong, strong recapture of zero and grinds higher into the close, but we did not get up towards trend zone. The cumulative tick is a bit more impressive out of the Nasdaq side of things, well above positive 5,000. And you can see we did have stronger inside, or I should say inflow/bullish reads on the Monday and Tuesday sessions. Wednesday speaks for itself with the FOMC drawdown over here. If we take a look, so overall, right, takeaway from internals, supporting the bullish move that we've seen thus far, but reasonable for a pullback based on the daily structure. If we look at the market profile for the NQ, it's the same as the ES, right? Value and the point of control does migrate higher with price, as it does on Wednesday during FOMC as well. Here you can see that precise touch to the lows of Tuesday, the gap fill reversal area. And if we start breaking down through it, the point of control should be the lower target on a deeper pullback. That's going to be closer to 14.8, not advocating for that into the end of this week, but that's kind of where we should look if we do start to see more of that downside activity. And also note that that's just shy, a little bit further than the equal high daily line in the sand that we were referring to on the structural chart. IWM Russell 2000 and the small caps remains in bull flag consolidation up here at the highs after breaking and doubling the weekly balance range from over here. This does strike me as very bullish and optimistic consolidation. Remember that as the Russell improves, it speaks to the broadening nature of the rally. So if this bull flag wants to break out from this consolidation range up and over 187.50 more firmly, we're looking for rotations into 190 and hopefully holding at that area instead of backing off like what we saw during the FOMC reaction. Now, IWM was impacted more so than our other market indexes here. So let's take a look at the hourly, but understand on the daily, right, that things are shaping up quite nicely here. If this was going to turn into a double top, right, there's your FOMC breakdown more severe. The retracement was not as significant or optimistic into the close of Wednesday. The threat on this morning's open, because we open right here, was that we flush underneath the neckline of this double top. It simply didn't happen. We held on to support beautifully at 184.75 and rotated back up towards the top of the range. So if sellers were going to have something going on, it should have been a flush of this level. Remember that we did technically flush it in the pre-market session, and then we rotated up towards the highs. So buyers remain in control. The consolidation on the daily time frame chart does strike me as bullish. To trade this long, we're looking for higher lows over 187.50, and that is playable into the end of this week. The Russell structure here is much more respectable than the NQ, than the ES, the S&P, the Nasdaq, right? Based on where we're at, right? This is definitely a reasonable trade because we have the structure to sort of provide a reasonable stop loss being placed. We don't need to look for an aggressive pullback first. The big concern on the Russell is obviously when and if this turns into a head and shoulders. We'll take it in stride, but we've got to break that neckline, right? It doesn't seem to be in play. It's going to be at 184.75. Apple kicks us off, producing a brand new all-time high into the close today after a beautiful break and retest with the higher low above 184.50. It's as simple as that. Watch your pivot there, 184.50, as long as we're above, looking for bullish outcomes. The only concern on the downside is if it turns into a head and shoulders. I wouldn't short the breakdown of 184.50. I would wait for the lower high proof underneath just because of the strength of the daily trend, which is up, obviously, and the fact that we're producing new all-time highs. Very bullish in Apple. 184.50 is your pivot. Next up is Netflix. What do we see over here? An inside bar on today's session producing an hourly ascending triangle. The breakout point here is 448.25. If we can clear that, there's some room to run into the bottom of an overhead gap at 460 from a previous earnings cycle, which was actually a gap down. If we go to a daily time frame chart, you can see that back here. That's what we're contending with overhead. I'm not expecting the gap to close tomorrow, obviously, but 460, the bottom edge of the gap, could very well be in play on a break of the ascending triangle. If it's going to turn into a double top, that's fine. Remember that we need to break the neckline and look for a lower high underneath if we're trading counter trend to a very clear daily uptrend at this point in time. That number is 436.50. What's going on with Tessie and Mr. Musk's rocket ship over here? Strong rebound after a gap down this morning, right? There was some volatility from FOMC. We opened on the gap down this morning. The sellers had an opportunity to produce a lower high underneath that FOMC volatility. It simply wasn't the case. Tesla clearly rebounds, getting price acceptance back above 250.75 and consolidating out into a bull flag for the afternoon. This chart setup is very straightforward. We are looking for price acceptance over 258.75 to close technically the gap all the way at 262.70. Anything beyond that, the doors open right back up. I'm certainly not calling for this right now considering the extension of the daily chart, but 276.75 is the next structural element to have on your radar. Shorts really don't have anything going on until we produce a lower high under 250.75. I mean, look at the reaction from this morning, right? It's got to produce the lower high before we even think about closing this gap down underneath us. Let's take a look at Google. This one proved me wrong. I was thinking that 122 was going to be in play as a flush point opening inside of this prior flag range here. after producing or potentially producing a lower high at 123.75. Instead, we rally, and you can even see intraday there was a pullback that respected the level. So going forward, it basically remains the same. This is on the table. Higher lows over 123.75, a repeat of this pullback here, are reasonable on the hourly time frame chart, and then we'll look for an equal high breakout over 125 to retrace some of this thin structure. The target overhead 128.25. If the market here in Google does start to just gap and go or just get straight up continuation tomorrow, look for higher low pullbacks over an upward sloping VWAP, and that will get us out of this range of doom, so to speak. Let's take a look at Metaverse. What's going on with the fantasy land over here? Strong rally on today's session, breaking that 275 level that we discussed in the pre-market prep. Fantastic move out of Meta into the overhead gap here. You know, you're just looking for the continuation. You're looking for the continuation. Obviously, any higher lows are well accepted over 275. I don't know about chasing this as a new money long. If you already have a long position, you just manage this into tomorrow's session. But new money longs, probably not ideal to be chasing it at the highs. You want to look for a higher low pullback. Ideally, it doesn't even have to go to 275 for the retest. But overall, the closure is up at 289.60, and 275 is your line in the sand on the downside. Anything underneath gets a little bit squirrely as a fake break. NVIDIA up next. What do we see over here? Strong move up and over the 411.25, right? So breaking out of this, there was a nice pullback intraday above that 411.25. Excuse me, that was yesterday. What am I saying? This is on the Thursday session here, right? The pullback went to it, and then we rallied off of it. So all things considered, really respecting the structure. Bulls remain on parade. Just continue to walk this one up. Blue sky territories, $1.50. Any intraday levels that form out of NVIDIA. Hard to say anything bearish about the chart. Only concerning for breakdowns if we're underneath 411.25. It's really got to do some damage here before we're concerned with breakdowns. This is a mild daily higher low pullback. Remember that we're still on the hourly chart here. This is Microsoft, absolute runner on today's session, beautifully taking out these highs. Another pre-market prep call that we were sort of discussing in that video. Hopefully you tuned into it, but 338.25 led to a beautiful breakout, new all-time highs into the close. Again, bullish, blue sky territories, $1.50, any intraday levels that do form. In a picture-perfect world, the pullback here does want to respect the prior all-time high. That level is 343.50. If we're above that, bulls on parade. Anything underneath with a lower high intraday, maybe you can make some scalps in the downward direction to retrace the thin structure. The line in the sand is where the breakout came from, the equal highs, 338.25 last, but certainly not least, we've got the mini beast putting in some solid consolidation up here at the highs, yet to really go on an impressive break in the upward direction. 127 needs some price acceptance above. So tomorrow's session, watching this closely. If we can get some price acceptance on the open above that, looking for rallies into the open from the Tuesday session, that level is going to be 128. So about $1 move available in the upside before running into that resistance. Anything beyond it, the doors really open up 130, 130. If we're just consolidating in here, it's not the end of the world. I would be a little bit more concerned if we start breaking down underneath 125.50. That is going to wrap up today's episode of the delayed but done midweek market update. Hopefully you enjoyed tonight's analysis. If you did or learned anything new, let me know down below in the comments section or by giving the video a simple thumbs up. I hope to see all of you tomorrow morning for our pre-market prep kicking off at 8:15. And with that said, I wish you a green trading week.